It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by TradingTips.com.
Welcome to this episode of TradingTips.com. In this video newsletter, we will be learning about the put-call ratio, which is a market sentiment indicator. Rather than being applied to an individual stock, the put-call ratio examines a universe of options in order to determine if the market is overbought or oversold. Without further ado, let's begin. The put-call ratio measures put volume relative to call volume. For those unfamiliar with options, let's take a moment to review. A put is an option that gives the holder the right to sell a stock at a given price on or before a specific date. The price at which the holder has the right to sell the stock is known as the strike price, and the date by which he has the right to sell is known as the expiration date. Since puts give the holder the right to sell at a specified price, puts go up in value as the stock's price goes down. Okay, with that out of the way, let's tackle calls, which are a little easier to understand. They give the holder of the option the right to buy at a specific price, again, the strike price, on or before the expiration date. So since the put-call ratio measures put volume relative to call volume, and since puts are bearish and calls are bullish, then when put volume is greater than call volume, this reflects bearish sentiment. Conversely, if call volume is greater than put volume, this reflects bullish sentiment. Since the indicator is a put-to-call ratio, this means that when the put volume is greater, the ratio will be greater than 1. And obviously, when call volume is greater than put volume, the ratio will be less than 1. As stated earlier, put-to-call ratio is applied to a universe of options, but which universe? Ticker $CPCE is the Chicago Board of Options Exchange equities put-call ratio, focusing on all options traded on individual stocks. Ticker $CPCI considers options traded on the major indices themselves, options on the S&P 500 for instance, as well as the Dow, the Nasdaq, the Russell 2000, the S&P 100, etc. Finally, there is $CPC, which includes both options traded on stocks and options traded on indices. Which of the three is the best to use? It depends, but we'll examine the differences between them later in this video. Now, how to interpret the put-call ratio? Well, as with most market sentiment gauges, the put-to-call ratio is intended for contrarian analysis. In other words, when market sentiment is excessively bullish, the interpretation should be bearish, and when market sentiment is excessively bearish, the interpretation should be bullish. Another way of thinking of this is that when the put-call ratio is very low, the market is overbought and due for a correction, and when the ratio is very high, it is oversold and due for a rebound. But how low is very low and how high is very high? Answering that depends on which universe of options you're using. And here's where it gets a little confusing. Since professional traders do a lot of insurance hedging with put options on indices, ticker $CPCI, which consists of strictly index options, always has a put-call ratio of greater than 1. By contrast, ticker $CPCE, which consists strictly of options on stocks, is usually below 1. When combining the two universes to form ticker $CPC, you get an average equilibrium level of approximately 1.0. But there are reasons you might want to use either $CPCI or $CPCE. In this case, it is best to apply a 200-day moving average to the indicator and gauge that as you would the 1.0 line. The more the indicator deviates from that MA line, the more significant. Now, just so you're comfortable reading put-call ratios, let's take a look at one example of each type. Here is a put-to-call ratio for ticker $CPCI, which includes only index options. Notice how the moving average line is well below 1.0. Now here is an example of ticker $CPCE, which includes only options on individual stocks. Notice how the moving average line is well below 1.0. Finally, here is ticker $CPC, which has a moving average line much closer to 1.0. We hope you've enjoyed this TradingTips.com video newsletter on the put-to-call ratio. Thank you for watching and good trading.
This Trading Tips video newsletter has been brought to you by Manny Bacchus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system. The First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. View more Trading Tips videos. Visit TradingTips.com. Sign up for our free video newsletters. and become a successful trader today.